Good morning. Today is January 5th. It is Thursday, and we were locked out of the office this morning, so bear with us. We won't be able to talk about Constellation Brands earnings because I don't really know what they are. But we do have a lot to talk about outside of that this morning. And we're going to start with the jobs picture. There was this big announcement that came out yesterday evening, reported in the Wall Street Journal, and then Amazon actually discussed it a little bit more in a letter written by CEO Andy Jassy this morning. And he said that between the reductions we made in November and the ones we were sharing today, we plan to eliminate just over 18,000 roles. Several teams are impacted. However, the majority of our role eliminations are in our Amazon stores. So that's the online Amazon business, and PXT, which is essentially HR. So much of the reductions is going to be in the devices and books business, including reducing some of the emphasis that they put on Echo, the Amazon Echo product. So 18,000 jobs between November and today. It's making a lot of headlines because Amazon's a big company. It comes on the heels of Salesforce's announcement yesterday. But 18,000 really isn't that much in the context of Amazon, which does employ 1.5 million people. And remember, in Q2 of last year, it was reported that Amazon quietly laid off 99,000 workers in a single quarter. By far the largest workforce reduction that I've seen. I think this is a little bit more, this is interesting because it's a little bit more corporate, more higher paid employees. Nevertheless, the stock market seems to like it. Amazon shares are up this morning as a result of these modest reductions. But again, it's less than 1% of the workforce and really in kind of corporate support functions. Tom, what are your thoughts on this?
I mean, it's just very much on trend. We've talked about this a lot, and I think we're starting to see what we thought was going to happen in the middle of the summer, which is, you're seeing a ton of tech jobs, primarily white collar, losing their jobs. The wild thing, though, is, this flies directly in the face of the ADP report that just came out at 8:30, which seems to suggest that the jobs market is actually accelerating, and not just a little bit. We're coming in very hot on jobs. So, it's so difficult to parse through this information because on one hand, you see the Facebooks, the Amazons, they're laying off people and it's in the high 5 digits, but on the other hand, we're getting these really, really strong jobs reports, and so how does the Fed navigate that? They're seeing the effects that they want, which is these white collar jobs getting smushed, but on the other hand, we're seeing hiring accelerate rapidly heading into the first quarter. What do you think your read is on that in terms of where we're headed rates wise?
Yeah, I mean, it just doesn't move the needle a whole lot. These anecdotal announcements, people like to draw these conclusions, and I must admit there's this temptation to draw conclusions from these anecdotal announcements. But if you look at the broader data, we're actually growing in spite of this, which suggests that the underlying is even stronger. And we'll talk a little bit about that when we get to the ADP print. The inflation piece, Tom, you alluded to, I think will also be interesting when we talk to ADP. The Fed, for its part, is really closely watching these job openings. They're watching the ratio of job openings to number of unemployed people in the United States. And right now, there are 1.77 job openings for every unemployed person. That is a November number. It was announced yesterday, and that is down from 1.95 job openings. So 1.95 down to 1.77, but so it's good, but it's not good enough in the Fed's estimation. They want to see fewer job openings. Job openings did come in higher than expected. So they declined, but not as much as people had anticipated. And the ratio of layoffs to quits was relatively unchanged. There are still 3 voluntary quits for every 1 layoff. So the primary reason for unemployment right now and people not having jobs is because people don't want jobs. So only 1 person getting laid off for every 3 people who are voluntarily quitting. Job openings fell the most in finance and insurance, which isn't a surprise. We know bonuses in investment banks and mortgages have really been crushed over the last 3 to 6 months. So that's not really a surprise on the job openings front. But as you point out, Tom, the ADP employment report that we got just about 20 minutes ago came in very hot, 235,000 new jobs. Bonds are selling off as a result. Interest rates are up. And wages continue to rise. Among job stayers, wages are up 7.3%, roughly in line with last month. And among job switchers, wages are up 15.2%, a little bit of an uptick from last month. And that corresponds fairly well to what the Atlanta Fed has been saying as well. So we're seeing this tightness in the jobs market, and we're seeing this pressure, upward pressure on wages. And it does seem like it might bode for continued inflation in wages, and therefore continued inflation in the overall economy, at least the way the Fed thinks.
Yeah, I think so too. I've been swinging back and forth whether or not I think the Fed's actually going to continue their path, and I think this pretty much cements it. I mean, we talked about when Jay Powell spoke last, if he focused on jobs, there are probably more rate hikes coming, and he definitely did. And then now we're getting these just, I mean, blowout numbers. From proportionally speaking, I mean, the 235 versus 150 is a huge overshoot. Not to mention they revised last month up from 123 to 182,000. So another $60,000 jobs on top of that.
So we're accelerating from a higher base.
Yeah, exactly. Yeah. So it's not even an acceleration from a low base. It's, you know, that went up and this went up as well. So you're looking at, you know, net, I mean, call it 150,000 jobs, you know, that we weren't expecting, almost double. You know, my thinking is that the Fed sees that they have some leeway. They see the growth is still there. They see that the jobs market is still there. They're seeing that inflation is still there. And I think that is a green for go for more hikes. But on the rosy side of things, so far they've managed to raise rates, I mean, exceptionally fast, and things still seem to be heading in the right direction.
And goods prices are coming down. We
And
saw
goods
that in the
yeah.
ISM manufacturing
And
yesterday.
yeah, inflation's coming down here and elsewhere.
Yep.
So the question is, you know, at what point do people start to settle in and say, hey, higher rates is okay, we're getting growth, things are okay. You know, maybe we already had the recession that everyone's anticipating for the end of 23.
We'll get the inflation report next week on the 12th. And actually next Thursday, to be specific. And I think that the focus there is going to be, what is services inflation doing? Because we know goods inflation is coming down. ISM manufacturing said that prices is down to 39.4 from 43. So anything below 50 is contraction. Prices are actually declining. They're not just not going up as much. They're actually in significant decline right now on the ISM manufacturing side, even as new orders are actually performing well and the economy is growing well. GDP now is calling for 3.9% growth in Q4, for example. So we know that the goods prices is coming down, overall economy is growing, arguably accelerating. The question now is, what does services inflation do? And we won't really find that out until we have the CPI report next Thursday. As a proxy for that, people are looking at wage inflation, which continues to be persistent. And so but ultimately, it's only because that's a leading indicator for services inflation. If services inflation begins to come down, I think that the market will look at that quite favorably. And the Fed will as well. The Fed minutes yesterday, Tom, talk a little bit about this, because it seemed to be a little bit more of a reiteration of what Jay Powell had to say at his press conference after the December meeting. But there was a phrase that stuck out to me, and they said, an unwarranted easing in financial conditions, especially if driven by a misperception by the public of how the Fed will react to economic developments, would, quote, complicate the committee's effort to restore price stability. Essentially saying, and this is very uncharacteristic from the Fed, especially the Fed minutes, which are not usually that direct. They're basically saying they don't want interest rates to fall, and they don't want the stock market to go up, because that is a definition of easing financial conditions. They want financial conditions to remain tight. And so the stock market and the bond market right now are counteracting some of the things that the Fed is doing, which is resulting in some of this hawkish talk that we're seeing from the Fed.
Yeah, which is interesting, because I would say net, the markets took this statement as relatively dovish. I mean, the markets were up for after this news came out, bonds were down, or yields are down, bonds were up in terms of price. And it seemed weird because everything in there basically said, we're afraid everyone's going to think it's over, and it's not. And then they also had some commentary in there about how they weren't super happy that China coming out of COVID lockdown had caused the stock market to go up. They obviously weren't happy about that. And so, I feel like I sound like a broken record, and there's been times where I feel like we've wavered a little bit on this, but I still think that the damage to be done could be in the upside in rates, that there's probably still quite a bit of hike, in terms of numbers that are coming, and they may not be all lumped together in 3s and 2s anymore, but I think we're probably going to continue to see rate hikes for the foreseeable future.
And the tricky thing is that's partly a function of the economy being stronger than expected.
And it is a good thing. It's a good thing for people who are in retirement. It's a good thing for the economy because it means that we haven't blown up. Everything is still fine. I mean, things are tougher, that's when higher interest rates make things tougher, but the economy is still just fine, and we're not on the verge of collapse or anything.
Jim Bullard talks today. I mean, so does Raphael Bostic, but I don't think really anyone really cares about that at 920. But Jim Bullard at 120. And any thoughts on that? Is he going to try to be a market mover today?
On the backs of this jobs report, I think he could do some real damage today. If he decides he wants to be ultra hawkish and say, hey, we need to reaccelerate, we need to go back to the 2s and 3s on the hikes, you could see some serious pain in bond world and in equity world, I believe. But he's unpredictable. Sometimes he's very hawkish, other times he's walking things back. So I guess we'll see how the Fed wants to spin it, and if they have any control over what he says.
We have the big unemployment report tomorrow. Do you think, in light of all the data that we've already gotten this week, the ISO manufacturing, the JOLTS report, the ADP report this morning, do you think that the national unemployment report will actually have much of an impact on markets?
I would say if it's fundamentally different than ADP, which has happened a few times in the last couple of years, where we've seen ADP come in either hot or cold, and then the actual Department of Labor statistics come out with something completely different. And that's the one I would take more seriously. Obviously, ADP, the number's so hot that I think there's going to be a big reaction. There's already been a big reaction this morning, but the real number comes out tomorrow. And if it's also hot, then I think you could see a continued slide.
Average hourly earnings, I think, which also get reported in that number, I think will be a critical component to watch.
For sure.
Right now, stocks have reversed early gains. They were up about 0.5%. Now they're down 0.5% on the heels of that better than expected ADP employment number. Just two last things to leave you with today: Western Digital and Kioxia. Kioxia is the spinoff from Toshiba's memory hard disk drive unit. So really, it's just Kioxia, Western Digital, and Seagate in that market, and it's a very old market. Commodity, and Elliott Management, run by Paul Singer, has been pushing for some strategic options for Western Digital for some time, and it seems like there may be a merger. They looked at doing a merger in 2021. Now looking at it again, it seems difficult for me to think that they'll actually get something done. With getting it all through regulators right now, going from 3 competitors to essentially 2. But we'll see what happens with that. We're following that. And then finally, one that we've talked about periodically is Bed Bath & Beyond. And they have just reported this morning in a filing that there are serious questions about their ability to operate as a going concern, which sets the stage for a potential bankruptcy filing in the next 3 months.
I mean, you heard it here first. I think we've been talking about Bed Bath & Beyond going bankrupt since March, probably.
Yep.
And so I think, they circle the drain very quickly. Usually it takes a lot longer for a company to, once they signal that they might go bankrupt, it could take years. But I mean, we're looking at inside of a calendar year from when the flag really went up for them to go under. So
higher interest rates will do that.
Yeah. It'll show you who really can't compete.
Yep. All right, we'll leave it there. Have a great day. Sun's out today. Big change from yesterday.
We'll see how progress is going with the locksmith on the main office and see if we can get in there. So
have a great day. We'll see you tomorrow for the unemployment report.